We are back at it again here with another video with Invest for Tomorrow. To the first time viewers and investors, welcome to the channel. To all subscribers, welcome back. And here we are with the SPY, the S&P 500 index, and we're going to break down what's going on here within the charts and within this volatility and sideways action. But today, while the SPY and the S&P 500 index continue to sit sideways, Tesla actually went higher, and our Tesla bot since 11:25 a.m. sent out a bull indicator, and from that moment forward, inflows crossed the midpoint to the upside with strength, and call options went up 100% plus within minutes to hours, guys. If you guys want to receive this clarity and edge over the charts, you can now gain access to it as well. The link is down below in the description to the 42 vision indicator, getting connected to our bots, and becoming part of a growing community of members using these resources to maximize in either direction within the volatility, whether stocks are going up or going down. Now, today was a big day because the FOMC meeting was going to set the tone of where the markets think the Fed is going to push the markets. And right now, the markets kind of don't even know where to go other than sit sideways here. And it's kind of stuck in this channel that we talked about yesterday at around 355 to 365. Will the bulls come over to take it over to the higher part, or will the bears come to tear it lower, right? That's what we're going to talk about today. But after today's meeting, we have a big day coming up tomorrow, which is CPI data. We're going to break that all down in today's video as well. And before we do, I want to share with you guys the home run opportunity I mentioned this morning over at the Discord. So the home run of the day was spectacular and beyond expectations. And if you guys want to know about these stocks early on in the pre-market, check out the link down below in the description to the Discord. And by joining, you'll become part of a growing community of investors, all looking to learn and grow together. So these are the three stocks I mentioned this morning. Every single one of them gave jumps of 3 to 5%, 5 to 10% plus. But one of them turned out to be a home run, and that was HPCO. Now, this was not our typical home run. Today was very choppy, but we caught this one in the pre-market pulling downwards towards the bell. I stated we were going to watch if inflows picked up. They never picked up until it finally hit a dip area here on 42 vision. Got its first bull indicator. Inflows picked up slightly before that, and it went into full strength and a full transition here on 42 vision. Plus the double bull indicators there as confirmations and staying above the midpoint. And it gave a highest point of 20% plus within minutes to an hour, guys. If you guys want to know about these stocks early on in the pre-market, check out the link down below in the description to the Discord. We look forward to having you join us, and let's jump into these charts. So here we are with the SPY, the S&P 500 index, and as I stated earlier in the video, stuck within this range here of 355 to 365. The bears will take over again if we break below that and hit newer lows. And if we break back above 365, it does not guarantee that the bulls are gaining strength, but it could show us that there actually some momentum here with some strength within the charts. Now, it's going to take more than that, and we're going to break it all down in today's video. I'm going to pull up the bull and bear indicators, which you can now gain access to as well. The link is down below in the description to the 42 vision indicator, getting connected to our bots, and becoming part of a growing community of members using these resources to maximize in either direction by receiving this clarity and edge over the charts within the volatility of the markets, no matter which direction stocks are going. And I'm also going to pull up the inflow versus outflow indicator, which adds that extra layer of confirmation within the volatility to see and give us that edge within the charts, guys. And this is our newest release that you can gain access to now as well. Once again, that link is down below in the description. So here we are with the SPY. The outflows have crossed here on the 30-minute chart under a bear indicator. And within this range, the bull indicator from yesterday got canceled pretty quickly. And this bear indicator popped up really fast to cancel it and take over and dominate over the chart so far. And today into the after hours, we're coming back down to retest the lows of the day of 356.35, currently at 356.73. And if it breaks through that, it could actually come to retest the lows of the 52-week lows, right? The lowest that we've seen in the last several days and in the whole entire year. Now, when you zoom out and look at this from the 1 hour, I have shared with you guys how important it was to cross back over this midpoint, and we continue to hang out below it. And even though inflows have been picking up, it's not enough to cross the midpoint and have an impact over the chart. Now, this bull indicator popped up literally at the peak of the move, and now things are actually sitting sideways. If no bear indicator pops up, this bull indicator in the bigger picture could still be in play if this breaks through resistance levels and starts bringing itself back up in a staircase manner. So it's super important to keep that in mind, and this is where tomorrow's CPI data is going to be super important, guys. If those numbers come in hotter than expected, it could create that whole stickiness and that whole entire narrative that CPI data is not coming down anytime soon, or actually spiking back up. And oil is one of the main things right now everyone has their eye on, as it got back over 90 a barrel and now it's coming back down. If this continues to hold itself up around this range or levels, that could actually roll into CPI in the next future dates, right? So that's super important to keep in mind as well, that this could affect indirectly the overall market as well, and the CPI data, because how CPI data comes out, it lets us know how the Fed is going to possibly react, and it could imply a much more aggressive Fed, a much more dovish Fed. We need to see what's going on and what is going up in CPI data, what is going down, and what is the year over year and month over month, because that's where the key numbers and data will lie. Now, very interesting enough, when you zoom out and we look at this from the 1 month, I've shown this to you guys before. We've had a bear indicator here since June. And on our 1 week here, you could see that we've been under a bear indicator since January. We got one bull indicator that turned out to be at the peak of the move here. Quickly, the outflows switched from green to red. They crossed the midpoint, switched from red with green borders to red bars very quickly. And it just got a bear indicator here just about 3 weeks ago, again at the beginning of September. And here we are in a downward trend. And the last time we got a bear indicator, this bear indicator lasted for about 6 to 7 months. And here we are with another one on the 1 week. And I asked myself, when it first popped up, how many weeks and months could it last again? Well, we have the outflows here to show us how deep the outflows went back in June, and they hit minus 61. We're currently only at minus 36. And in the 2020 crash, which was really, really quick, we saw the outflows go as low as minus 90, minus 80. So something to keep in mind here as things continue to play out. And we're currently under a bear indicator on the 1 week and on the 1 month. And I've shown you guys this chart before as well, and we've compared it to the history of other charts. And I'm going to pull up something here that you definitely do not want to overlook. I shared this in a previous video last week, and this is super important for technical analysis purposes, and where a lot of these price targets that a lot of large investors and hedge funds may be coming up with their numbers and price targets for the possible drop. It's not guaranteed, but something to watch and keep in mind. But let's look at this article together here, because this is super important. So here we are with the CEO of JP Morgan, right, coming out and stating an easy 20% drop in the S&P 500 from here, it looks like, right? This is not guaranteed, but it is a very large investor, CEO of one of the biggest banks. I mean, he wouldn't be saying this for no reason, right? And he's the one that stated since last year that we are in a hurricane, not just a storm, but a hurricane that's about to come. And he stated it as we started pulling back. And here we are in a big, big mess with inflation no longer being transitory, if you really think about it. Now, we also have these type of headlines here stating why the S&P 500 can fall another 11% as the Fed fights inflation. And this is important as well. Why? Because you're starting to see a trickle effect or a common similarity between all these articles. Drops from here, whether it's 5%, 10%, 11%, 20%. There's drops being priced in the words, right, of these investors, and it's what they're seeing based off the Fed's decisions. The market got excited here the last several weeks, right? If you go ahead and look at this from the 1 day chart, when things ran here from 362 all the way up to the 430s, it was with the whole entire speculation of a Fed pivot next year or sooner than expected. Then quickly things started to fall. CPI data is getting entrenched. We actually went from a 0 month over month to about 0.3 or 0.6. I do not recall right now. I do not have that data point up with me. But turns out that we had a month over month that was 0% rising, and all of a sudden inflation was rising month over month from August to September, and it created this big trickle effect back down. And then when we zoom in here and look at this from the 30-minute, this big run right here that happened last week and in the last several days was all due to the fact that everyone was getting excited because England was pivoting, and now that the Fed could possibly pivot or follow as well, right? Turns out the Fed is not going to, and England had to pivot not just from their first pivot, but from their second pivot back to unpivoting, right? Sounds a little bit complicated, but basically they had to stop what they were about to do. They went from quantitative tightening to quantitative easing to now stating, no, we need to tighten. We cannot do quantitative easing just yet. So a lot of speculation and hype behind a possible pivot, and I believe we are far from it. And the Fed has stated they're going to do everything it takes to get things tamed down, specifically inflation, at the cost of volatility. That's just my opinion and perspective alone, not financial advice. I could be completely wrong, but that's what I've noticed. That's what I've been stating all year. And here we are. Volatility has been king in this market, but within the volatility, there has been multiple opportunities to catch these bull indicators and these dips all the way up to these rip areas, and actually on the way back down when those bear indicators pop up, all the way down to these weakness areas of extreme weakness of white with red borders, right? So it's been phenomenal, and especially when those inflows cross, those outflows cross in either direction, I mean, it has just given us that edge and opportunity to maximize while everything else looks like it's collapsing. Within these moves, there has been plenty of opportunities, and that's just the way I see it, and that's what I've been stating all year. So back to this article here, right? This is the CEO of JP Morgan. Now, he states here that the S&P 500 can easily drop 20% from here, and if it does, well, that means that it's going to get close to 3,000 to 2,800 based off these numbers. And if you read here, the number is right here. Such decline would push the S&P 500 to 2,871. Now, I'm going to show you guys where it is that experts, quote unquote, are getting these numbers from. And this is more for technical perspective. It is a lagging indicator. It is not very good for active trading, if not just technical analysis and analyzing charts and speculating on the possibilities. But if you look at history, it has always been hit and bounced off of in the history of the charts. Very few times have you seen the purple line cross over and stay below it for very long, right? It was back here in the dot-com bubble, and then also the 07-09 crash. But every single time that the actual bars, right, in the charts have actually broken below the purple line, right, and actually touched the blue line, we have bounced off of it, right? Very few times that it's crossed over and fell a little bit lower than that. I mean, the worst was the 2000 bubble here, where it actually tried to bring itself back up very quickly afterwards. And then the 07 one, it took a little bit longer than expected, almost half a year before it started to recover. The recent runs have actually happened very, very fast, just bouncing off the purple line. And then also in 2020, it bounced off the blue line. And here we are with the purple line coming downwards. We've been under a bear indicator since way up here. And even though the 1 week just crossed, if you look at it, this is how you know this is a lagging indicator. It just crossed in the most recent bear indicator. We've had a bear indicator since January, and now is when a lot of people are starting to notice this, or hedge funds and managers are now looking at this technical analysis and stating, oh, well, this is about to cross. Now it's getting pretty bearish. Well, we've known since January with 42 Vision and our inflow versus outflow indicator. And same thing here as things recovered. We got that indication here with our bull indicator, and it even missed this bear indicator because it never crossed. So super important to realize how lagging this is, but this is where they're getting their numbers from, because if you look at this blue line, it's down here at around 305, 306, and that is where they're getting these numbers of speculation between 280 to 306 if it tries to find support based off the history of the chart and the last time it actually touched and fell slightly below that blue line, we found a bottom. Is it guaranteed to be the area of the bottom or even be reached? No, it could actually end up being worse, right? Like what happened in 2007 or the 2000.com bubble, but nothing is guaranteed. All we have is charts, technicals to watch, but I wanted to show you guys where it is that they're getting these numbers from and why it is that it's possible if they're right and why it is something you want to keep in mind. So keep these levels in mind. Worst case scenario, 280 to 300. And then based off this line right now, it is currently at 306 and things are pulling downwards and we're under a bear indicator here on the 1 month. As always, guys, thank you guys so much for watching. I look forward to seeing your thoughts down below and let's make some money.